Andrew Slimmon, Senior Portfolio Manager and Head of Applied Equity Advisors at Morgan Stanley Investment Management. And Andrew, you're smiling. Are you smiling because you're in love with U.S. exceptionalism? Or are you smiling because, well, you've basically bailed out and you're now investing in Europe?
Rain, yeah, I think why I'm smiling is what scares me the most, what keeps me up at night the most is this retail frenzy into euphoric stocks. And the more that the Fed actually says we're a little bit more on hold, that lowers the temperature because euphoria is the tail end of a bull market. And we're moving too quickly through the optimism phase. So I'm happy if things just calm down a little bit. The Fed says we're not going to cut rates quite as much, and the markets move and start to look for other places. I think that's actually healthy for extending the duration of this bull market.
What does extending the duration of this bull market look like, Andrew? And I mean that in the context of, are we going to look at another sort of double-digit percentage increase for the headline indices, or should we maybe expect something a little bit more modest as people rotate out of those larger cap names, those bigger weightings, into names that, in theory, on their own, can't really move the market?
Well, yeah, I mean, I think that's true. I hear a lot of people predicting that it's over for the mega cap tech stocks, and part of me, Romaine, being cynical, could this be asset allocators who, asset allocation models haven't really worked because all you wanted to buy the S&P? Could it be active management that has underperformed because they didn't own enough of the mega cap tech stocks? Part of me thinks that is a big reason why people are hailing this. I wouldn't bet against these stocks. I think there's many of opportunities beyond that. So I'm not espousing just own them. But I do think it's healthy for the market to see a broadening out. But after 2 great years we've seen in the markets and a lot of buying frenzy gets me nervous where these are weaker holders. Think about this, Romaine. If you had bad news that you were long equities in 2023 and you'd held on through 2022, you probably weren't selling when bad news hit in 2023. Yeah. But now we have an all new group of people that have come in the last 6 months, and they're probably more likely to hit the panic button because they didn't, they weren't as invested early in the bull market. And so that's why you tend to get more volatility in the third year, and it's a low returning year. So I think the likelihood of deeper shocks lowers, actually, if we don't get as much buying frenzy in these retail, these kind of quantum AI type stocks. That's what scares me the most.
How much do tariff threats scare you, Andrew? Tariff threats versus actual tariff implementation. And I ask because we keep talking about how the talk of tariffs is discouraging investors from doing very much, but they're still keeping stocks near record highs. That's
true. I think that's just adds to the uncertainty, right? And the more, Fed on, little less dovish adds uncertainty. Yields go, steepening. That makes bonds a little bit more attractive. And the uncertainty of tariffs is another reason why I think it adds to it's not a negative year, but it won't be quite as good as the last 2 years. I think that's accurate. And then finally, it's been documented, but this kind of period from late February until tax day, retail tends to sell because they got to come up and pay for capital gains. So that takes the air out of a lot of these, more speculative stocks that have been the big winners year to date. Unprofitable tech is certainly one of them.
Okay, so the seasonal factors to consider as well. As we wait to hear more of these tariff announcements, if and when they do come, and depending on how long they are actually in effect for, are there sectors that are just resistant to any of these headlines? I think about financials and how well they've done this year, not just in the U.S., but globally as well.
Yeah, I think financials are the big winners because, especially the banks, they're benefiting from the steepening yield curve, net interest, margin. I think the asset management, wealth management organizations, because with $8 trillion coming, sitting in the money market as the Fed lowers rate, and we can discuss the speed with which they lower rates, as that money comes out into higher returning vehicles, that's good for those industries. So I think financials are a clear beneficiary, but caveat, there's a lot of expectation of a big capital market cycle, and you can see that the private equity and some of the pure investment banks are kind of rolling over, and that's maybe the capital market cycle is going to be more drawn out, which I would actually argue is another reason why we won't get to euphoria, because that's typical a sign of a late stages when you get tons and tons of IPOs and things like that.
Well,
so I like financials. But again, I wouldn't bet against tech because I think the big thing that tech has going for it is we all know about artificial intelligence, Scarlett. But what we haven't really discussed yet is the profitability, margin improvement broader sectors are going to experience by this, this use of artificial intelligence for things like back office and so forth. That was why the market rallied so forcefully in the late 90s until we know the dot-com bubble blew, right? Yeah. But that's why you had 90, 97, 98, 99 was really the broad application of the internet. I think that's still to come in terms of artificial intelligence.
All right. Well, Andrew, tech stocks are getting a modest bid here on the day. 5 of the Mag 7 in the green. Have to leave it there. Andrew Slimmon, Senior Portfolio Manager over at Morgan Stanley Investment Management.